So here we're going to compare the basic depreciation methods. As you see with straight line depreciation, the amount of depreciation is the same over each year. So you'd have the same amount of expense every year. With units of production, it's not accelerated. It's tied to production. So it will change each year based on what your production is. And then with, say, double declining balance, there's a lot of depreciation in the first year, and then it very steadily and drastically decreases as we move from one to the other. Total depreciation in all of these cases, though, will be the same, regardless of which depreciation method is used, because it is cost less salvage value. In this case, $45,000 was the depreciable base. You will have $45,000 of total depreciation at the end of the useful life. We're going to talk for a minute about depreciation for taxes. So most corporations are required to use the modified accelerated cost recovery system for tax purposes, also called MACRS. MACRS depreciation provides for rapid writing off of an asset's costs in order to stimulate a new investment. MACRS absolutely ignores salvage values when computing annual depreciation. And the Internal Revenue Service actually has a determination that they apply to the useful lives. So you have to follow that determination based off the class of the assets. You can find more information about MACRS and the classes in a couple of places. Most clearly, you will find it on your on the IRS website. If you go in and you search for MACRS, it should populate several options for you. So what this tells you is that what you're doing for financial accounting, what the cost allocation is for financial accounting, will be different than that is reflected in the income tax filings for the organization. The depreciation will be different. There are some other differences between what we do in financial accounting and what the IRS requires, but just know that this is one of those things. During the useful life of an asset, it's not always going to be perfect. It's going to require some things like preventative maintenance, the regular and routine repair costs that are associated with the period in which they're occurred. So when a vehicle breaks down, it needs an oil change. These are the types of things we're talking about. These are absolutely regular expenses in the period in which they occurred. They are period expenses. They are not capitalized back to the asset. They are recognized as an expense. Eventually, at some point, you're going to have to dispose of a depreciable asset. When depreciable assets are sold, we update the depreciation in the books to the date of disposal, and we journalize the disposal. We debit cash for the sales price. We debit accumulated depreciation account to remove the balance that has been depreciated from the accounting records. We credit the asset's cost account to remove the asset from the accounting records. And then we will either debit a loss or credit a gain to record whether there is a loss or a gain tied to the disposition of this asset. Those gains and losses from asset disposals appear on the income statement. They're not something that is regular, operating, or planned necessarily. So, how do we know if there's a loss or a gain? how do we determine that? Determining gain or loss happens when cash is greater than the book value. So what you receive is greater than cost less accumulated depreciation to date. You will have a gain. You will have a credit. However, if cash is less than the book value, you will have a loss, which will be a debit. In the event that you receive the exact same amount of cash as book value, then there is no gain or loss. It's just a break-even type of a situation. Now, we've talked about assets that are purchased. Now let's talk about assets that come in by what is called a capital lease. An operating lease is an ordinary lease for the use of an asset that does not involve any of the attributes of ownership. Whereas a capital lease results in the lessee or the renter assuming virtually all the benefits and risks of ownership for the leased assets. This is one of those areas that was very gray and wonky for many, many years. Now we have more clear guidance on how to deal with specific types of leases. So the characteristics of a capital lease. To be classified as a capital lease, the lease must transfer ownership to the lessee, so to the renter, include a nominal purchase price. The lease term must be equal to or greater than 75% of the life of the asset. The present value of the lease payments is equal to or greater than 90% of the fair value of the assets. A lease will be classified as a capital lease if it meets any one of these characteristics. Now let's talk about buy or lease when it comes to an asset. Should you buy or lease? So if you buy computer equipment at a cost of $217,765, you could issue a 10% 6-year notes payable with an annual payment of $50,000. Or you could lease the computer equipment at an annual lease of $50,000. Note that the present value of the lease payments at 10% for 6 years is $217,765. Let's move forward in this consideration. If purchased, the computer equipment is reported on the balance sheet as an asset and a notes payable at a value of $217,765. You have annual depreciation that would be recorded in the accumulated depreciation account. The annual note payment will decrease the balance in the notes payable. Depreciation expense and interest expense as incurred will be reported on the income statement. If leased, the computer equipment is reported on the balance sheet as an asset as well, and a notes payable at the value of $217,765. Annual depreciation is recorded in the accumulated depreciation account. The annual lease payments will decrease the lease liability. Depreciation expense and interest expense as incurred would be reported on the income statement. When engaging in a capital lease, which that was, remember present value of the payments is 90%, it was exactly the same. When leasing underneath a capital lease, it is essentially the same as buying it. Both methods of acquiring the asset will yield the same economic impact and the same effect on the financial statements. This is where we got that additional guidance when it came to leases. whether it is an operating lease or a capital lease, is an imperative determination. No longer can you hide that liability and just recognize it as a rent expense. Now, another type of non-current asset, but that does not actually have physical substance, is an intangible assets. The useful life of intangible assets is often really hard to determine. They provide the exclusive rights or privileges, and they are usually acquired for operational use. Intangible assets are recorded at current cash equivalent costs, including purchase price, legal fees, filing fees. So it's very similar to like plants, property, and equipment. Some of the intangible assets you are likely to encounter at some point in your life, or you may have some awareness of, are patents, copyrights, leaseholds, leasehold improvements, franchises and licenses, trademarks and trade names, and goodwill. With an intangible asset, we do not engage in depreciation. We use what is called amortization. Amortization is the term used to refer to the allocation of the costs of the intangible asset over its useful life. It is a very similar process to straight-line depreciation. Amortization for a patent equals 20 years. A registered trademark has an unlimited life, and a copyright equals life of the artist plus 70 years. Using the straight line method, an intangible asset is amortized over its legal, these are their legal lives, the 20 years, life of the artist plus 70 years, or its useful life, whichever is less. So, for example, with a patent, if it is determined that whatever this new great idea is only really going to be useful for, say, 12 years, even though the patent gives you 20 years exclusive use, you would only go with the 12-year period for your amortization. The intangible asset goodwill is kind of a creature of its own. Goodwill occurs only when one company buys another company. Only the purchased goodwill is an intangible asset. This is the amount by which the purchase price, so how much company A pays for company B, exceeds the fair market value of the net assets that are acquired. So let's take a look at that real quick. Using Cruisers Incorporated, who paid $1 million to purchase all of James' company's assets and assumed liabilities of $100,000. The acquired assets were appraised at a fair value of $800,000. If we subtract the $100,000 of debt that was assumed, the fair value of the net assets equals $700,000. Knowing this, and then taking into account that goodwill is the difference between the purchase price and the net assets, what amount of goodwill should be recorded on Cruisers Incorporated's books? I'll give you just a minute to ponder that. Using the equation of fair market value of assets less debt assumed, giving fair market value of net assets at $700,000 and a purchase price of $1 million, there is $300,000 of goodwill that will be recognized on Cruisers Incorporated's books for the acquisition of James. Goodwill is an intangible asset that is not amortized. What we do is we test it annually for impairment. If the book value of the goodwill exceeds its fair value, an impairment loss will be recorded. Moving forward to natural resources. Natural resources are a little bit different as well from other types of assets. The total cost of a natural resource is going to include exploration and development and is charged to what is called a depletion expense over the periods benefited. Natural resources are extracted from the natural environment and are reported at cost less their accumulated depletion. Some examples of natural resources: oil, coal, gold, natural gas, minerals, timber. There's a lot of different natural resources. The term depletion refers to the allocation of the cost of the natural resource over its useful life. This is engaged through a process that is similar to the units of production depreciation. Other non-current assets that you might encounter include long-term investments, notes receivables that have maturities more than a year after the balance sheet date, long-term deferred income tax assets. When these assets become current, they are then reclassified to current assets. Just as a real quick refresher, we'll do just a couple of seconds, it seems like, on the time value of money. Remember, there is a separate video that's a little bit more in depth on the time value of money, which you should have covered in prior classes. The future value and present value are the basic time value of money applications. The future value of money is used to determine the value at some future date of an investment that is made today. Future value refers to the amount accumulated when interest on an investment is compounded for a given or said number of periods. So for an example, an investment made today of $1,000 will return $1,464 4 years from now if it's invested at a 10% interest rate. Present value analysis involves looking at the same compound interest concept, but from the opposite perspective. The present value of money is used to determine the value now today of an amount to be received or paid at some specific future date. If a specified amount of money is needed in 4 years, then calculate the amount of money to invest today at a given rate of interest to yield that specific amount. So for example, if $1,464 is needed in 4 years, then we can invest $1,000 today at a 10% interest rate and have the $1,464 4 years from now. Remember, there is a separate recorded lecture that deals more in depth with the time value of money that is available for your use.